Hi, this is Scott Dahl. I'd like to welcome you to number 8 in my podcast series. Thank you for tuning in. This is a lot of fun for me. I would strongly encourage you, go back to number 1 and work your way through, because what I'm doing through this exercise is I'm giving you a knowledge base, not only on technical analysis, but I'm giving you an idea of what I use, the tools that I use to manage my clients' money. So what I want to do today is I want to start out with doing something fun. I want to talk about Charles Dow and explain why Dow is so important to modern day markets and modern day technical analysis. He virtually laid the groundwork for technical analysis. Now, he was born in 1851. He died in 1902. But before he died, he did a series of editorials from 1900 to 1902 in his newspaper, the Wall Street Journal. And he talked about the markets, talked about the cyclical and the secular movement of the markets. He defined these different movements. And what he did to visually communicate this was he used his indices. So he created the Dow Jones Industrial Average. And the reason he created this index was it would be representative of the average American's portfolio. That way they could look at the Dow and they could determine potentially how their portfolio was doing, because remember back then you didn't have the internet. You got your quotes out of the newspaper. So all the data was kind of slow. So that was the advantage of the Dow Jones Industrial Average. Then in 1897, what he did is he kind of split things out, or he created a secondary index, which was the Dow Jones Transports. So you had the industrials and then you had the transports. The transports were predominantly railroad stocks back then because that's how goods were transported. But what he did is he started looking at these two indices and he used them to determine what kind of trend we were in and the strength of the trend. So that's what we're going to look at briefly today to see if this current rally in the market has legs. Now, a gentleman by the name of William Peter Hamilton, he was the editor of the Wall Street Journal. When Dow died in 1902, he picked the basis of his theory up and he continued to run it and add to it through 1929. He wrote a book in 1922, which is a very important book for a technical analyst. It's called The Stock Market Barometer. And in this book, what he does is he gives us an idea of how to use Charles Dow's theory. So it's called Dow theory. There's 10 tenets to Dow theory. I'm going to show you one today, is price. The idea is the Dow Jones Industrial Average and the Dow Jones transports, they called them the rails back then, but so it's the industrials and the transports, they need to be moving in the same direction. They need to confirm each other's movement. Now, there's a basic fundamental reason for that, because if the transports are doing well and maybe making new highs, and the Dow Jones Industrial Average is making new highs, well, that's confirmation, because the transports, that's how you move the goods. So that gives you an idea of future economic activity. Two things about the Dow theory. Number one is the Dow has three movements. There's three movements, according to Charles Dow. There is the primary movement, which I've discussed before, which is a long-term secular trend. There's the secondary movements, which is a move against a trend, or a secondary movement might be considered. Remember the person going up the escalator and it's got a yo-yo, it's going up and down. So you've got the primary trend, you've got the secondary trend, which are these shorter term cycles inside this longer term movement. Then you have noise, and that's a daily movement, which is just strictly noise. It has absolutely no predictability whatsoever. Now, here's something I find incredibly interesting, is that Charles Dow, he created the basis of this type of wave theory by sitting and watching the ocean. He determined that the tide was the primary trend, or the secular trend, and then the waves would be the intermediate trend, the ebbs and flows of the larger trend. And then the ripples in the rocks, all that was noise, which had no predictability. And that's the day by day movement. So that's one of the problems with watching the news. If you watch the news, you get so focused in on these minute day to day movements, and they mean absolutely nothing for your investment success. In fact, they could even be counterproductive. But you watch the news because it's exciting, it's entertainment, and that's why people watch these programs, and they're not necessarily going to help your investment success. So anyway, let's look at the Dow. The number one tenet of Dow theory is the averages must confirm. Now, what do I mean by that? Well, let's take a look at the screen. So this is the Dow Jones Industrial Average, and this is, you can see back here, we've got data from latter part of 2021 all the way through to current day. And you also can see that there's a trend line. So this is a downtrend line that has been drawn from January of 22, and it right in November of last year, that trend line was broken. So this is the daily price of the Dow Jones Industrial Average, and you can see that it's right now 38,923. It's been in a significant uptrend from October. So it broke this downtrend line. It didn't even look back. So that's a very, very strong trend in this Dow Jones Industrial Average. Now let's look at the Dow Jones Transports. So the Dow Jones Transports have also made an up move from that low back in October. However, it just now, 3 weeks ago, it just now broke that trend line and started to move higher. So is this market viable? Is this trend viable? Is this a trend that should continue higher? Yeah, should continue higher based on what you've seen right here, Dow theory. You can see again that the Dow Jones Industrial Average is going up, making new highs, and then also the Dow Jones Transports have broken this downtrend line. It's continuing to make highs, not new all-time highs, but it's getting there. So you've got confirmation both of these indices are in sync. So if according to Dow theory, there are other tools that you need to use, but to simplify, just looking at price, according to Dow theory, they're in sync, and that we're in a powerful move, a very strong move, and the business cycle should continue to get stronger. This is not me. This is what I'm seeing here with Dow theory. So let's move on and look at breadth in the market. Remember last time I talked about breadth? Breadth is participation. So what's driving this market now truly is one stock, artificial intelligence stock. So it seems like that AI is driving this entire market. Well, that's kind of a scary thing because you need a lot of stocks going higher for a continuation of a bull market. Now, the good news is we're seeing some continued breadth. Remember we talked about breadth and the stocks have to participate. I used the New York Stock Exchange index, and I looked at the breadth of the New York Stock Exchange index. I looked at the participation. I looked at how many of those 2,000 stocks were going higher. How do we look at that? We looked at it graphically, and we're going to look at it right now to kind of bring you up to date. You can look at breadth of all different indices. I can look at breadth in the NASDAQ. I can look at breadth in the S&P 500. To condense it down, I just picked the NYSE, the New York Stock Exchange, because it's the traditional index that breadth was measured on 70 years ago. So let's just continue with it. So nothing's really changed from the previous podcast. We saw this breakout of this trend. We're seeing a significant move higher. This is all the way back to January of 21 to current day. So this is a lot of data. As I've explained in the past, each one of these bars is a day. You've got the green as an up day, the red is a down day. And this breakout is significant because of this tremendous coiling pattern or this triangle that's been created. So we broke out and we're headed higher. This is the New York Stock Exchange. So now let's look at the breadth of the New York Stock Exchange. So remember the concern has been all along that there's only 7 stocks or maybe even less stocks now that are driving this entire stock market. That could be true. However, if you look here, what we're seeing is the stock market is continuing higher. We see the breadth of the New York Stock Exchange is continuing higher as well. We're seeing a breakout of creating these new highs in breadth. So that would indicate that more stocks are participating in this up move. So that would also be indicative of the fact that we're broadening out. There's more stocks participating. So this up move is probably going to have more strength and could continue further. One thing I would like to point out is there was a lot of cash on the sideline by individual investors. So this could be this FOMO, they call it, the fear of missing out, which is propelling this market higher because individual investors, they don't want to miss that party. So they're piling in right now. I don't see a whole lot of institutional purchasing. Typically, institutions are the smart money. So that's got me a little concerned. However, there's an old adage, the trend is your friend. So you've got to participate in this trend. So this is what I see right now. I'll be back with another podcast. Then we'll take a look at what's occurred. This is not set in stone. I mean, as frothy and as strong as the market is, we could see these sell-offs at any time. Remember, I believe that we're in a cyclical bull market and a secular bear market. So we will have a sell-off, and it'll be a pretty brutal sell-off. But right now, it looks like things are pointed higher at this present time. So if you have any questions, give me a call. It's 949-497-6366. You can email me, Scott@dahlcapitaladvisors.com. Call me, email me. be happy to discuss these further and discuss what I could potentially do for you. So thank you again for tuning in. I greatly appreciate it, and have a wonderful day.